Introduction. The main question is about what is the appropriate level of the cash rate. First, what is RBA? It's a duty of Reserve Bank Board, within the limits of its power, to ensure that the monetary and banking policy of the bank is directed to the greatest advantages of Australia, and that the power of the bank, in the opinion of Reserve Bank Board, will best contribute to the stability of the currency of Australia, the maintenance of full employment in Australia, and the economic prosperity and welfare of the people of Australia. Today, we will use other three important factors to support and justify our outcome for the cash rate and monetary policy: inflation, stability of financial market, risk of consumer spending.
The first factor that affects monetary policy is inflation rate. The monetary policy taken by the RBA depends on the condition of the economy. The target of inflation rate is 2 to 3%. When the economy overheats, which means the inflation rate is higher than the target range of 2 to 3%, the RBA can enact contractionary monetary policy to control the economy by increasing cash rate. When the country's economy weakens, the RBA will choose the expansionary monetary policy to stimulate the economy through increasing cash rate. In 2017, the inflation rate in the first quarter is 2.1%, which is within the 2 to 3% target range. For the second quarter, consumer prices rose just 0.2% in the June quarter, pushing the inflation rate decreases to 1.9%, which is below the 2 to 3% range target. However, inflation isn't rapidly moving below the target band, nor is it rapidly lifting back into the target band. Therefore, by the analysis of inflation rate, the RBA may sustain the level of cash rate 1.5% for the next quarter.
The monetary policy's capacity to affect risk-taking by investors and financial institutions establishes its critical hold on the financial stability of a country. The RBA describes a stable financial market as one in which the flow of funds occurs efficiently between surplus and deficit units. Recently, the Bank of Canada increased the Canadian cash rates by 25 basis points, and an increase of 10 basis points was also observed in the Chinese economy earlier this year. This occurred to minimize any further financial instability in the economy. The RBA has kept interest rates steady for 10 consecutive meetings as the financial stability concern prevents any decreases and the weaknesses in the economy preventing hikes. The Reserve Bank tends to increase the cash rates during periods of instability and maintain constant cash rates when financial markets are stable. Therefore, it is safe to predict that the RBA will sustain the current levels of cash rates in October.
Risk of customer spending is an important factor of cash rate. One of the big strains on household budgets and spending is the record level of households, mainly housing debt. Now, because of the high and still rising debt level, there will be more pressure on households to pay back the debt. This would make the customer spending level more fragile and make more probability for debts to be unpayable. If we raise cash rate, cost of debt will increase. This situation will get even worse, and if we decrease cash rate, the cost of debt decrease, the housing price will get more affordable for the customers. As a result, the housing price will be more expensive due to the higher demand. Then this will fuel the Melbourne and Sydney property market. So remaining the cash rate same would be the best choice, since the fragile economy might not be able to afford big changes on customer spending level.
Conclusion and recommendation: an appropriate cash rate can grow the flow of the funds and the economy. Therefore, after analyzing these three factors, inflation, stability of financial market, and the risk of consumer spending, the three objectives of monetary policy has been satisfied by these three factors. All of these three factors show the suitable level of the cash rate is more likely to remain the same, which will cause the monetary policy statement unchanged. However, in the future, the cash rate should be monitored to avoid uncertainties in domestic and global economic conditions.